Good morning, everyone, and welcome to Brookings. My name is Stephanie Aronson, and I'm the Vice President and Director of the Economic Studies program here at Brookings, although, to be honest, I've only been in the role for 3 weeks. In fact, you all are the first audience I've had the pleasure of welcoming to Brookings in this new capacity, and so I'm very grateful to each of you for showing up here this morning. We're here today to discuss the current state of financial regulation and to hear from the person perhaps best situated to share the latest developments, Federal Reserve Vice Chairman for Supervision, Randal Quarles. Before joining Brookings, I too was at the Federal Reserve providing analysis to policymakers on the U.S. economy and labor markets in particular. So I recognize how critical a stable financial system is to our economy and to all who participate in it. In that role, I had the pleasure of interacting with Vice Chairman Quarles on a few occasions, and I'm grateful that he was able to stop by this morning and share his valuable perspective. Quarles was confirmed as Vice Chairman for Supervision a little more than a year ago. And just 6 months later, Congress passed new legislation to adjust several aspects of the post-financial crisis financial regulatory framework created by Dodd-Frank. Vice Chairman Quarles continues to play a vital role in the implementation of those regulatory changes, which is one of the many reasons I look forward to his remarks today. Vice Chairman Quarles brings to the Federal Reserve Board decades of experience as a banking lawyer in both the public and private sectors. Directly prior to his appointment to the board, he was the founding and managing director of the Sinosure Group, and before that, a partner at the Carlyle Group in Washington. He also spent several years at the Treasury Department, first as Assistant Secretary for the Treasury for first as Assistant Secretary of the Treasury for International Affairs, and later as Undersecretary of the Treasury for Domestic Finance. Given the interconnectedness of the global financial system, his experience in both domestic and international affairs is surely invaluable to his work at the Federal Reserve today. I'll close with a little bit of information on today's program. We'll begin, of course, with prepared remarks from Vice Chairman Quarles. Following his remarks, he'll be joined on stage for a moderated Q&A with Brookings Senior Fellow Martin Bailey. Vice Chairman Quarles will also take questions from the audience. To conclude, we'll hear from a panel of experts moderated by Brookings Fellow Aaron Klein. With that, I'd like to welcome Vice Chairman Quarles to the stage. Thank you for being with us here today.
Thanks, Stephanie, and thanks to Brookings for inviting me to speak today. It's an honor and a pleasure to speak to this distinguished audience. Very pleased that people would want to show up for such a wonky topic. And obviously, Brookings scholars in this area are extremely distinguished. They include former chairs, vice chairs, senior leaders of the Federal Reserve, many others, some of whom are in this audience, who did the hard foundational work of developing and implementing many of the new post-crisis measures, including stress testing, which is what I want to talk to you about today, some of the changes we're proposing to make in stress testing. And under those circumstances, my showing up at Brookings and discussing changes to our stress testing regime could sound uncomfortably close to the serene arrogance of Alfonso X of Castile, who famously said that had I been present at the creation, I would have given some useful hints for the better ordering of the universe. My thoughts today, however, are not a call to rewrite Genesis, but rather a recognition that our stress testing regime, like the banking and financial system that it evaluates, will and should evolve as we continue to learn from experience in the management of this tool. And in the best traditions of the Federal Reserve, this evolution should be grounded in rigorous analysis of the data and a commitment to continual improvement of our methods. So in my remarks today, I'll begin with what's been successful about the stress tests, why those elements should remain. I'll spend some time discussing some of the changes we proposed to our stress testing program and how we're now thinking about moving forward with those changes. And after that, I'll discuss the tension between, on the one hand, providing additional information to the affected firms, while on the other hand, ensuring that the tests remain effective. And finally, I will close with some thoughts on the qualitative element of our stress testing program. The adjustments that I'll discuss are intended to increase both the transparency and the efficiency of the stress testing regime. Enhanced transparency goes to the very core of democratic accountability and to the rights of all U.S. citizens, including the management and shareholders of the institutions that are subject to the stress tests, to understand the requirements to which they are subject. And it also helps to ensure the continued credibility of our regime. So let me begin with a short discussion of the core elements of our stress testing program. So as most of you know, one of the most visible aspects of our stress testing program is that the firms and the public receive an independent view of the capital adequacy of the largest banks. The results are based on our own models and provide a consistent yardstick to measure resiliency across the banking system. But the stress test that's conducted by the Fed is only one part of our stress testing regime. Just as important, in our view, we require each firm to run its own stress test using its own models and a stressful scenario that reflects the firm's assessment of its idiosyncratic risks and key vulnerabilities. Underpinning a firm's stress test is the firm's ability to identify and measure risks under both normal and stressful conditions, and the strength of the firm's internal processes around that assessment, and we use our supervisory process to ensure that the firm's stress testing practices employ sound methodologies. So the combination of the Fed's common yardstick, the firm's own stress tests, and supervisory oversight over the firm's practices has resulted in a meaningful increase in the post-stress resiliency of large financial institutions. All of these core elements will remain in place. In addition, the changes I'll talk about today are not intended to materially alter the overall level of capital in the system or the stringency of the regime. A healthy U.S. economy relies on a strong, well-capitalized banking system that can weather stressful events and continue lending to households and businesses. The U.S. banking organization subject to the 2018 Comprehensive Capital Analysis and Review, or CCAR, which is the Fed's evaluation of capital adequacy for large holding companies, have increased the dollar amount of their common Tier 1 capital from around $500 billion in 2009 to more than $1.2 trillion as of the second quarter of this year, have more than doubled CET1 risk-based capital ratios from approximately 5% to over 12% over the same period. But while the regime has been successful overall, in my view, I believe it's prudent to review all of our practices to ensure that they are as efficient and transparent as possible, and that they remain appropriate in light of changes in the industry that have been achieved. For instance, as firms become more resilient, they may no longer need to build capital to support their current level of risk-taking, but rather move into the mode of retaining the capital they've already built. Firms have also significantly improved their risk management from before the crisis, providing room to adjust our approach to assessing their practices. And finally, as we make changes to our regime, the issue of volatility in the stress test results becomes more pronounced. As I'll discuss, we're considering how to balance the need to preserve the dynamism in stress testing with the need to ensure that firms have sufficient notice regarding the capital requirements to which they're held. Now, many of you in this room are familiar with the Federal Reserve's proposal to integrate the stress test with the regulatory capital rule, known as the Stress Capital Buffer, or SCB. And if you're not, you may be on the wrong plane. But I believe the SCB proposal represents an important milestone as we enter the next chapter of our stress testing regime. But for those who aren't quite as familiar with the SCB, let me provide a little background about how our capital rule currently works and how it would be modified by the SCB. So as devoted readers of our capital rules may know, our regulatory capital rule includes both minimum capital requirements and a buffer that sits on top of those minimum requirements. The buffer serves as an early warning to a firm and to its supervisors, and it requires the firm to reduce its capital distributions as the firm approaches the minimum requirements, as it eats through the buffer down to the minimum. Under the current capital rules, all firms are subject to a fixed buffer requirement of 2.5% of risk-weighted assets. And the largest firms are also subject to a global systemically important bank surcharge and a potential countercyclical capital buffer. For the large firms, the SCB would replace the fixed 2.5% risk-based buffer with a firm-specific buffer, the size of which would vary from firm to firm based on the firm's stress test results. In this way, we're integrating the automatic restrictions on capital distributions in the current capital rule with the output of the most dynamic tool we have for assessing risk, the stress test, to create a more robust and dynamic but also simpler regulatory capital regime. The SCB would result in a more transparent and simplified system of regulatory capital requirements because a firm will be held to a single integrated capital regime. Now, when we made our SCB proposal last April, we'd aimed to make the SCB final for the 2019 stress test cycle. But the comments we've received have been extensive, they've been thoughtful, and they've raised issues that require a carefully considered response. I don't believe those issues will ultimately prevent us from implementing the SCB, but they've flagged certain elements of the regime that could benefit from further refinement. Accordingly, I expect that we'll adopt a final rule in the near future that will settle the basic framework of the SCB, but repropose certain elements. And to enable this process to run its course, I expect that the first SCB would not go into effect before at the earliest 2020. For 2019, I expect CCAR will remain in place for firms with over $250 billion in assets or that are otherwise complex, but we'll consider whether we could move forward with any aspects of the SCB proposal for CCAR 2019, such as assumptions related to balance sheet growth. And again, for people who are familiar with the proposal, you know what some of the assumptions about the content of the stress test, in addition to the form of the stress test that were included in that proposal, and we need to consider whether there are any of those questions of content that could be included in the current stress test, even though the SCB won't be effective for that cycle. I will also ask the board to exempt firms with less than $250 billion in assets from the CCAR quantitative assessment and supervisory stress testing in 2019 in light of the every other year cycle contemplated in the tailoring proposal that the board approved 2 weeks ago. Returning to the SCB proposal, I want to give you a sense of some of the comments we've received and our approach to addressing those concerns. The issue that's foremost in my mind is the volatility of the stress test results. One concern that was frequently expressed is that the results of the supervisory stress test can lead to capital requirements that change significantly from year to year, which limits a firm's ability to manage its capital effectively. Some amount of volatility is necessary to preserve the dynamism of the stress test. By nature, the stress test will differ year over year based on macroeconomic conditions, contemporary understanding of salient risks in the economy. And in addition, the stress test results are sensitive to changes in a firm's balance sheet, which means that a firm's capital requirements will evolve as the firm's activities and exposure evolve. But I do think there's an important balance to be struck between preserving this dynamism and ensuring that firms have sufficient notice regarding the capital requirements to which they're held. In the first years after the financial crisis, as the banking system was dramatically ramping up the total amount of capital in the system, this volatility was less of a management problem. Until we reached reasonably full capitalization, every year, every bank needed to increase its capital. And if one year that increment was a little higher or a little lower than the previous year, that was simply a modest difference of velocity, not direction. At the current juncture, however, both our system as a whole and each of the largest banks in that system are fully meeting their capital requirements. Chairman Powell and I have both said on more than one occasion the amount of capital in the system is just about right. In these circumstances, having a highly variable capital requirement presents a significant management challenge. So we're considering ways of preserving the dynamism of stress testing while reducing its volatility. And we plan to seek comment on a proposal in this area in the not-too-distant future, and that's not too distant in real time, not Fed time. In addition, we're also exploring ways of improving our approach to measuring risks in the trading book. Firms' trading books are dynamic and complex. Firms hold both long and short positions. Many have noted that a single market shock doesn't adequately capture the risks in firms' trading book. Those are sensible comments. We're exploring ways to incorporate multiple market shocks in the stress test without adding volatility to the results and without increasing the compliance burden, which, as you can imagine, the Venn diagrams there overlap over a relatively small area, but that's what we're trying to accomplish. We're also considering adjusting another element of the SCB proposal in order to provide more notice to firms. Currently, and both how we currently run the stress test and in the SCB proposal, as we originally put it forward, a firm must decide whether to increase or decrease its planned dividends and share repurchases for the upcoming year without a knowledge of a key constraint, which is the results of the stress test. In other words, we require a firm to give us a formal plan for dividends and stock repurchases without knowing what its effective capital requirement is. If it guesses wrong, it could be publicly shamed for failing the stress test. If its dividends are too high relative to capital, or it could be penalized in the markets for inadequate distribution of income if its dividends are too low relative to capital. Now, admittedly, at first blush, this structure could appear to be pointless and obdurate cruelty, but the reason behind the practice was initially perfectly sensible. It reflected the view that firms should think rigorously about their capital uses and needs in developing their capital distribution plans, rather than rely primarily on the results of the supervisory stress test to guide those plans. But now that we've all had several years' experience with this system, firms have told us that they would be able to engage in more thoughtful capital planning if they had knowledge of that year's stress test results before making final their distribution plans for the upcoming year. I'm very sympathetic to those concerns, and I'll ask the board to adjust the operation of the rule so that firms know their SCB before they decide on their planned distributions for the coming year. This adjustment in sequencing will also help firms manage volatility in the SCB. Obviously, we expect firms to continue to maintain robust stress testing practices and to use those results to inform their capital distribution plans. We'll continue to use our supervisory process to reinforce that expectation. The comments that we've received also highlighted an issue with how the capital buffers operate today, and that's amplified by the inherent volatility of the SCB. So as I noted earlier, a firm operating in its capital buffer is required to reduce its capital distribution so that it can build capital over time. Now, by design, the buffer was intended to apply increasingly stringent limitations as a firm's capital ratios decline. So you're supposed to be moving along a continuum. But in our current world, in which a healthy and profitable banking system is seeking to maintain its capital levels rather than continue to increase them, a bank can appropriately and safely tend to distribute much or all of its income in a given year. It's in maintenance mode as opposed to increase mode. But in that case, given the way that the capital buffer rules are described, the minute you dip into the buffer, you would have to completely cease all of your distributions as opposed to having a gradual ramping down, even if the changes in your capital levels are quite minor. So we're considering adjustments that would make the rules more consistent with the graduated intent of the structure. And we'll work with the other banking agencies to consider how best to effect that change. There are two additional elements of the SCB proposal that I think would benefit from modification. First, the SCB proposal would have included 4 quarters of dividends in a firm's SCB in recognition of the fact that firms experience market pressure to hold dividends constant even under stress. But in my view, and this view is shared by many regulators around the world who have similarly stringent expectations and regulatory structures, there may be ways of encouraging greater reliance on less sticky repurchases while providing more flexibility in the regime, and we're exploring alternatives. And finally, the SCB proposal would have included a post-stress leverage requirement. Now, the Federal Reserve has long maintained, so I don't want to overstress that. We've long maintained, we haven't always maintained. We haven't always maintained. I don't want to sound too much like we have always been at war with East Asia. But we have long maintained that leverage requirements are intended to, are important elements of our capital regime, but they're intended to serve as a backstop to the risk-based capital requirements. By definition, they're not intended to be risk-sensitive. So I'm concerned that explicitly assigning a leverage buffer requirement to a firm on the base of risk-sensitive post-stress estimates runs afoul of the intellectual underpinnings of the leverage ratio. So I would advocate removing this element of the stress capital buffer regime. That's not removing the leverage ratio. Leverage ratios, including the enhanced supplemental leverage requirements, would remain a critical part of our regulatory capital regime and will maintain a supervisory expectation that firms have sufficient capital to meet all their minimum regulatory requirements, including the leverage backstop. Together, the adjustments we're contemplating to the SCB offer promise in improving the efficiency, coherence, and transparency of the regulatory capital regime while maintaining the overall level of capital in the system and the core principles of the regime that have proved successful. That being said, we welcome a continued dialogue with the public as we implement these changes, and through that implementation, we'll ensure that we maintain the incentives for effective stress testing practices that exist today. Now, transparency of the stress test and its inputs and outputs is key to the credibility of the test. And there are several initiatives underway to provide additional transparency regarding the supervisory stress test models and the scenario design process. We think that the adjustments that are under development strike the right balance of advancing transparency while maintaining incentives for firms to think critically about their own risks. So I expect that soon you'll see the Federal Reserve, and again, soon in real time, not Fed time, you'll see the Federal Reserve issue a policy statement describing governing principles around the supervisory stress testing process. As part of that statement, I'd expect a commitment to disclose additional detail on the supervisory stress test models and results, and to publish portfolios of hypothetical loans and associated loss rates. I expect that we'll begin providing some of this additional detail starting in early 2019, and that these changes will allow firms to benchmark the results of their own models against those of the supervisory models. But our commitment to transparency doesn't end there. We're currently considering options to provide additional transparency regarding scenarios and the design of the scenarios, and I expect that the board will seek comment on the advisability of and possible approaches to gathering the public's input on scenarios and on the salient risks that are facing the banking system in each year. Such a proposal may also provide additional details about the scenario design features that underpin each year's scenarios and a range of other enhancements. Additional transparency regarding the stress test scenarios serves multiple purposes. It provides additional due process to affected participants, and I as a former lawyer, I couldn't underscore enough how important that is in any governmental process. But it also provides additional sources of insight, including from academics and thought leaders like many of you in this room, that could be used to inform a given year's scenario. Increased transparency could also enable us to be more nimble in our scenario design to the extent that we uncover through external input new salient risks that we haven't previously considered. As we develop proposals, a key consideration is to ensure that we maintain incentives for firms to conduct their own stress tests rigorously and thoughtfully. Firms have indicated that additional disclosure about models would not affect their own stress tests, and we expect them to make good on that representation, as the Federal Reserve stress test is not and cannot be a full picture of a firm's resiliency in light of its idiosyncratic risks. For example, there's some risk that firms will use knowledge from additional transparency about the stress test to engage in transactions that are solely designed to reduce losses in the test, but that don't truly reduce risk in their portfolios. As supervisors, however, this is something we can guard against through the regular examination process, and will closely monitor changes in the firm's portfolios and take appropriate actions to ensure that firms are holding sufficient capital and have sufficient controls and governance in light of the risk characteristics of their activities. Before I close, I'd like to say a few words about the role of the qualitative objection in our new chapter of stress testing. As originally conceived, and again, if all of this, if this isn't familiar to anyone in the audience, by now you are scrambling to figure out how we can land at the nearest intermediate point and you can get on the right plane. But as originally conceived, CCAR had both a quantitative component based on the supervisory stress test and a qualitative component based on the Federal Reserve's assessment of a firm's stress testing practices. In 2017, the Federal Reserve eliminated the qualitative objection as part of CCAR for large but non-complex firms, in part because of improvements in risk management at these firms. That's not an elimination of our concern over their practices with regard to their internal stress testing and capital management, but by incorporating supervisory stress testing into the regulatory capital regime and introducing an automatic penalty if a firm falls below its SCB-derived capital requirement, the SCB proposal will eliminate the quantitative objection from CCAR. The natural next question is, has the CCAR qualitative objection for the largest firms also run its course? In my view, the time has come to normalize the CCAR qualitative assessment by removing the public objection tool and continuing to evaluate firm stress testing practices through normal supervision. In such an environment, firms would remain subject to the same supervisory expectations. Examiners would continue to conduct rigorous horizontal and firm-specific assessments of a firm's capital positions and capital planning, tailored to the risk profile of the firm. While much of the examination work would center on a firm's capital plan submissions, examination work would continue on a year-round basis for the large firms, taking into account the firm's management of other financial risks. The evaluation of the firm's capital position and capital planning would culminate in a rating of the firm's capital position and planning, and firms with deficient practices would receive supervisory findings through the examination process and would be at risk of a ratings downgrade or enforcement action. If those deficiencies were sufficiently material, we would simply remove the public shaming element of the qualitative objection. So in conclusion, as we begin the next chapter in stress testing, my objective is to ensure the continued credibility of the program by increasing its transparency, its simplicity, and its stability, while maintaining the strength of the supervisory and internal stress testing elements that are central to the program today. These adjustments will be coupled with our continued commitment to strong supervision and our expectation that financial institutions ensure that they're managing their risks and holding sufficient capital to continue operations through times of stress. So thank you again very much for having me here today on this wonky topic, and I'm looking forward to our discussion.
Okay, the button works, the microphone works. So thank you so much. That was terrific. I got to hold the mic there. Thank you. And my phone will probably go off in a minute too, but never mind. So thank you so much. As you're well aware, you've gotten some comments and criticisms coming from folks who think that the changes that you're making in financial regulation have not gone far enough, and so we're not doing what the president wanted to do, which was to increase the amount of lending, encourage economic growth. And then you've gotten criticisms from folks who think you've gone too far, that you shouldn't be loosening regulations, that Dodd-Frank should be kept in place, and nothing changed. So I'm going to ask questions that sort of come at you from both directions, if that's okay. Gentle questions. And so the the capital rules that banks are facing. So this is sort of in the direction, have you done enough to try to improve or make regulation more efficient and encourage economic growth? So the capital and liquidity rules that banks face are or have been extremely complex. And the description you gave of changes to the stress test indicate maybe some simplification, but it still sounded like a very complicated regime. So, and I know that John Dugan, when we were working at the Bipartisan Policy Center, he used to complain there are 9 different capital ratios that he had to look at with the leverage ratio. Then there was the liquidity you have to look at as well. So do you think you're on a path, or have you done enough to kind of simplify the capital regime so banks can operate more efficiently?
So I think we have proposed a lot. Our own count actually is that in the current regime, banks are subject to 24 separate capital measures, and with
more than 9.
More than exactly more than 9, and with the SCB proposal that we put forward, that would reduce the number to 12, which is still more than 9. So. But it's a move in the right direction, and I think a significant simplification of the regime. And most of the comments that we've received have acknowledged that. Now, I think that at any moment we shouldn't consider, the job of the Fed should never be to consider its work over, but rather to continue to think about, well, how can we continue to improve the efficiency of the regime? But I think that those are significant steps towards improved efficiency.
Let me ask you to comment on the Volcker Rule. So that's something that's been, it's in the law, so, it's there. It's something that the banks have had a hard time with. It's something that regulators had a hard time sort of setting up. I think there is sentiment in the Federal Reserve to simplify the Volcker Rule. So could you give me a comment on that? I don't think we want to go back to the days when you had huge risky trading floors with inadequate capital, and we know where that went. But are there proposals, or how do you see the Volcker Rule playing out? And do you think it's actually damaging, for example, as has been claimed, issuance by smaller companies, smaller bond issues, because of the presence of the Volcker Rule making it more difficult for institutions to make markets?
So to take the last part first, I do think that there have been effects on markets from the Volcker Rule. They're difficult to quantify precisely, but there is, I think, universal sentiment among market participants that the Volcker Rule has affected liquidity in some markets, and I think that's probably true. Reasonable people can differ about the extent of that. I think that there is universal agreement that the rule as it currently exists is too complicated. It's too complicated from the point of view of supervisory enforcement. It's too complicated from the point of view of firm compliance. And I think that it is totally sensible, as for that matter does Paul Volcker, to have a much simpler approach to implementing both the letter and the spirit of the Volcker Rule provision in the Dodd-Frank Act. So I think that's eminently doable because I said there's universal agreement on that. The 5 relevant agencies are working together to process the comments, very thoughtful comments that we've received in response to the proposal that was put out earlier this year. And so I expect that process will come to a successful conclusion.
When you announced the tailoring process, there were some comments, maybe some complaints that you weren't doing anything for the GSIBs. If the goal is to try to ease regulation, to make money more available for businesses, as Willie Sutton said, you go where the money is, and that's, to a large extent, that's the GSIBs. So if the capital requirements are about the same, the TLAC requirements for those banks are about the same, maybe we're going to simplify the stress test a little bit, but have you done enough to make sure that the large banks are able to play the role that's needed in order for a growing economy to have access to funds?
So we're continuing to look at the framework that affects the largest banks. As I've said, our objective is not to materially change their capital requirements. There are a lot of things that are in the works, Basel III implementation, for example, that would, other things being equal, result in material increases in their capital requirements. I think we have to think through how we think about that in light of an overall view that this is a system in which the capital level is just about right. But with respect to the criticism of the tailoring proposal that came out last week, didn't do anything, or maybe it's 2 weeks ago now, how time flies, didn't do anything for the largest banks. Well, that was focused on implementing CRAPO, which didn't do anything for the largest banks. Not CRAPO the man, but CRAPO the bill.
The bill.
And required a huge amount of Fed resources. I mean, I don't want to necessarily overstress this, but I think we put out that implementation proposal in, if it is not the fastest implementation of a major piece of regulation in the history of the Federal Reserve, it is certainly among the fastest 2 or 3, which required significant devotion of resources to that effort. And now that proposal is out there and we're processing comments, we'll turn resources to thinking about other parts of the system.
Let me sort of cross the street now and sort of raise some of the concerns that have come from the folks that think maybe you're doing too much. So one of the most common things that I hear, and I'm sure that you hear, is to say, look, we have a very hot economy. People are reaching for yield. We're maybe even beyond full employment. This is a boom time. This is a time when we should be tightening the screws a little bit on the banks, on the financial institutions, not easing the rules. So we want it. It's really sort of the macro-prudential approach. So could you comment on that reaction to the proposals?
So to that, I'd say a couple of things. One, to the view that we're relaxing in the face of a boom, I really don't view the regulatory proposals that we have put forward, those that we are thinking about, those that I talked about today, as relaxation. I think that what we're doing is recalibrating, in light of experience, the post-crisis regulatory regime in order to achieve the same objectives. There's no one on the Federal Reserve Board, no one in the financial regulatory leadership, frankly, that disagrees with the fundamental objectives of post-crisis regulation, which is to have more capital, more liquidity in the banking system, to have a safer and sounder system. But we also need to look at that framework through the lens of efficiency, because we have a strong public interest. It's not just a question of the banks feeling overburdened, but we have a strong public interest in the efficiency of the operation of that system and its support for the real economy wherever we are in the economic cycle. So that's the first thing I would say, is that I do think that when looked at fairly, what we are doing is sort of, I think, very justified recalibration as opposed to relaxation of the regime. But the second thing I would say is that we're, with respect to what people most frequently talk about is, at this point in the cycle, shouldn't we be pushing against the cycle as the countercyclical capital buffer? Right. And we have a very clear framework that we have talked about for turning on the countercyclical capital buffer, which refers to an assessment of overall financial vulnerabilities. So the countercyclical capital buffer, as it was discussed internationally, as it has been implemented both internationally and in the U.S., is a financial stability tool, not a sort of macroeconomic dampener, if you will, and is designed to be, in our framework, quite explicitly, we say we designed to turn it on when we think that financial stability risks are meaningfully above normal. Now, quarterly at the Fed, constantly, the institution is assessing financial stability, but we have a formal quarterly process in which the board reviews with the staff our current assessment of financial stability risks, and our assessment currently, as we have said, is that those risks are moderate. There are certain areas where you have clearly elevated risk, valuation pressures in certain asset classes, certain sectors where there's elevated leverage. But overall, the very strong position of the financial sector, the low leverage in the financial sector, the high liquidity in the financial sector, the adjustment of household balance sheets, all of that feeds into an overall assessment that our financial stability risks are moderate currently, and therefore in our disciplined and methodical framework, you would not turn on the countercyclical capital buffer. There are regimes around the world that are rethinking this notion and saying, well, maybe the countercyclical capital buffer could be used more appropriately as kind of a macroeconomic dampener as opposed to purely a financial stability flywheel, if you will. But we haven't done the work here. We haven't gone through that process here in order to do that. And so I think as we think about using that tool, we need to do that in a disciplined way. And our current discipline is to thoroughly evaluate financial stability risk, to view it as a financial stability tool. And in those circumstances, you wouldn't turn it on.
So in your judgment, and I understand that the banks that you supervise and regulate are in good shape, so to speak, that they've got the capital, they've got the liquidity, and so you're not seeing red flashing signs going on, even though the economy is strong.
So we're not. I'm very mindful that in my nomination hearing, similar statements that I had made earlier in my life were brought to my attention again. But
they do that in confirmation processes, don't they? Yes.
But no, we're not. In fact, we're going to be releasing later today a supervision report with a very comprehensive assessment of the current state of the banking industry, and all the data would show that it's a very healthy industry.
So, all right, so let's go outside the regulatory perimeter for a minute. I mean, one of the concerns about Dodd-Frank was that it would strengthen the institutions that are subject to Fed supervision or careful supervision, but there are institutions that are not as, that you don't see into, that you don't necessarily regulate in the same way, that maybe have some other regulator. And I hear concerns about leveraged loans, for example, coming out of non-bank institutions. There are concerns about asset managers that may be reaching for yield and taking unnecessary risks. So, and I also note that the FSOC has basically decided that no non-bank shall be included in Federal Reserve supervision. So are you comfortable with where the regulatory perimeter is, or do you fear perhaps something that would happen outside of that perimeter that would, in the end, impact financial stability in the banks?
So I think that's an interesting question. At the Federal Reserve, we regulate the banking sector, and absent designation have limited responsibility and visibility into other parts of the financial sector, obviously. But we do have some visibility, and what really is if you think about what the real risk is, it's whether some of these other structures that are holding these assets, how leveraged are they? And we do have visibility into that from the fact that the leverage will tend to come from the regulated banking sector, and that's something that we are always monitoring. Again, currently we don't view that as raising significant risks, but we are always monitoring that. I would refine a little bit your statement that the FSOC has said that no non-banking institution would be designated and placed under regulation by the Fed. I mean, the FSOC is focusing on a designation by activity, if you will, sort of
right.
Focusing on what activities are there, which is a tricky thing to do, but is in fact being quite diligently and quite rigorously pursued by the FSOC. And I think conceptually is probably even more accurate than the previous entity designation approach, because conceptually that's what we ought to be concerned about, is are there activities that could be conducted by any institution, whether it's a bank or a purple panda, that could be affecting financial stability, and if so, it's those activities that we ought to be looking at, and that's what the FSOC is trying to do.
Okay, I've always agreed with that it's sort of activities you'd like to regulate. It's actually hard to do because the activities occur within institutions.
Yes.
And so what's your control over that activity? It's through the institution, right? So I've got lots of questions I'd love to ask. I think I'm going to ask two more and then throw it open. So the resolution process. I've always been enthusiastic about the development of the single point of entry approach, the creation of TLAC, unsecured long-term debt, as a buffer in the event that a bank gets into trouble, and the process that I think the FDIC has put in place to resolve large institutions. But I think the question about that is, well, what if we had a really bad crisis, the kind of crisis we had before? Hopefully we won't for the next 100 years, but maybe we could. So we could imagine that a couple of GSIBs were in trouble, going down, maybe a couple of other banks, 2 or 3 other banks. Could we manage to resolve all 3, 4, 5 institutions at the same time without there being a big crisis, or are we going to end up looking like the previous crisis? In other words, do you think this resolution process is really strong enough to withstand a big crisis that could hit sometime in the future?
So I think the best answer to that, at least that I have, the most honest answer that I have, is that I view the too big to fail project, if you will, as ensuring that policymakers have more options in the event of the next instance of very widespread stress, and I think that the post-crisis regulatory regime has done that. I think the work that's been done on resolution has done that. So if you do face a period of widespread stress, I think that policymakers will have more options. Which options they choose, what they choose to do, will depend on the circumstances of the time and the policymakers at the time. I also think that what we have done with respect to resolution significantly puts off, reduces the likelihood that you will have kind of the need to resolve many institutions. One of the reasons that many institutions were resolved, even in the last crisis, was the uncertainty as to how you could resolve even one.
Yep.
And I do think that our ability, the much greater clarity we have into how we could resolve even a very large institution, even if it were only singular, reduces the risk that you will then have to resolve 3 if it's clear how you can resolve 1.
Okay. All right. For my last question, I want to go back, since your speech was about the stress test. I'd like to go back to that. And you mentioned the increase in transparency around the stress test. Now, I must admit, I was surprised when the stress tests were put out that there was so little transparency, and I know the banks sort of felt they were, walking into a minefield. They didn't know what was coming. When I talked to folks, I remember a conversation with regulators at the Fed in New York. Their view was that we don't want to give away the exam questions before the student takes the exam, because then the exam wouldn't be worth anything anymore. So you've decided that you want to increase transparency. So say a little bit more about how you've done that in such a way that it makes it easier for the banks, but at the same time, presumably, you're not just giving away the exam.
So for me, the question about giving away the exam, I will admit that I've always been a little skeptical of that, about the ability of the firms to game. For me, that part of the criticism or support for opacity, it's really not a question of giving the banks the test questions as opposed to are we going to give them the textbook. But I do think that there is a genuine concern about the so-called monomodel problem, which is that to the extent that it is absolutely clear what the Federal Reserve's stress tests are going to show, what the models are, there's an almost irresistible incentive. I mean, it's just going to happen that because that will ultimately govern, that's what the banks will do, and their own thinking about their internal risks will erode to some extent. Now, I don't think that they, it's not like the will of Landru from the old Star Trek, and they're only doing what the Fed says, but
I missed that episode. Sorry.
I can do them all, but
That's right.
Good for you.
but but nonetheless, there would be that erosion, and and as I said in my speech, the Fed does not have it exactly right. No one who's going to have that complex of a model is going to have it exactly right. There's going to be judgments, there's going to be mistakes, there's going to be idiosyncrasies, and if there is one model to rule them all of the risks in the system will congregate around those fault lines. So I think that's a real concern. Now, opacity is only a halfway measure in dealing with that concern, because one of the reasons why there's less noise about transparency than there was even a year ago when I arrived at the Fed is that the banks are reverse engineering. Every time you have an iteration of a stress test, it's easier to figure, so that's what happens. That's what they do. That's what they're thinking. And so ultimately that monomodel problem doesn't disappear simply because we are opaque about the model. So I think we have to do more thinking about that. But that's why we are proposing more transparency, because I think that's a matter of due process. I think we get more comment from folks in this room about, how can you improve the test to ensure that it remains dynamic and useful. I'm less worried, as I said, about the gaming issue, and we need to continue to work on the monomodel issue.
Thank you. I'm going to ask for questions from the audience. Could you please identify yourself? Could you make it a short question and not a speech, and hopefully relevant to the topic of this event? So we have one at the back. Yes, please identify yourself.
My name is Mark Tenney.
Oh, wait, we do need a mic.
Thank you, ma'am. Yes, my name is Mark Tenney. I'm involved with capital and asset adequacy work in the life insurance industry, and I helped calibrate the economic scenario generator used to set capital and reserves for life insurance companies. Currently, the Academy generator, which is required for reserves, is unable to create scenarios that start at 0, go to 5, and back to 0 in short-term rates, and has trouble keeping rates close to 0 for long periods of time. Just to give you a little bit of information for those not familiar, life insurance companies do 10,000 scenarios at monthly intervals.
We need a question in there here, yes.
Okay, so the question is, the inability of the Academy generator to produce what I call the Larry Summers scenario, short rates go from 0 to 5 and back to 0, or to produce long periods of low rates. Do you consider that a systemic risk? And do you think that they need to improve their generator to include those scenarios?
So I haven't considered that question up to now.
I was going to say, I'm glad you're answering that question and not me.
But I would say that as we think about stress testing, and my own view about stress testing is that it should, you should have the ability in the creation of scenarios to design a variety of different shocks, and some of them should be quite unexpected shocks. There's a question as to then what you do with the information that you get, but the point of stress testing is to shock the system in ways that might not otherwise be expected, that aren't day to day. In the 2018 stress test, we included an actual steepening of the yield curve, even in light of a significant macroeconomic event, which is not what one would normally expect to happen, but which could happen. There were reasons to think that this might be an environment in which it might be particularly, that unusual thing might be somewhat more usual than others. So how would the system evolve and result to that? And I think that those sorts of unexpected shocks is something that a good stress testing regime ought to have the ability to incorporate and not to do.
Question. Here, yes. We need a mic on the side here.
Hi, Heather Long from the Washington Post. Are you concerned at all about the slowdown in the housing sector? I get notes that say it's a canary in the coal mine for the broader economy and maybe even for banks and bank lending. Curious what you think.
Okay, so I'm one thing that I should probably have made clear at the outset, but we just had our FOMC meeting yesterday, and our blackout policy extends for 1 day after the meeting to, I guess, to prevent us all from stampeding over each other out of the room. So I actually can't comment on sort of macroeconomic or questions that would affect monetary policy today. I'm sorry about that. Ordinarily, the meeting is over on Wednesday, and I think when we set the time,
When we set this time,
it
yeah.
was precisely because the meeting would be over, and then because of the election. Although we should have known when the election was. But in any event,
we were just happy we found a date at all. That was a long struggle. Okay, question here, and then I'll go to the back.
Morning, Raj Date from Fenway Summer, Vice Chair Quarles. Thank you for being here. I marvel at your ability to render these hyper-technical issues in ways that are very slightly less hyper-technical. So, thank you. If you had asked me 10 years ago, which you did not, but 10 years ago, I would have thought that if we had both higher and more transparent levels of risk resilience in the system, that one, yes, depressingly would see lower returns on equity, but simultaneously one would see lower costs of equity because investors would sensibly, expect less volatility. Is that A, true, and B, happening? And if not, what do you think about why not?
So I think that's an interesting question. I think that I think that it hasn't really been true up to now, but I think that's because there's in the sort of increasing capitalization of the system. But there's an increasing awareness of investors, or a different view of investors, as to what capital is necessary in order to make an institution safe, and therefore a different point at which you reach the area where increasing capitalization will in fact result in a sort of decrease in the ability of the system to provide credit and economic growth. And so I think up to now, we're only just entering that area. We've been building capital in the system up to now in a general sense, I think a correct sense, that that there was always more to come, and appropriately so, and each increment would in fact make the system safer without a particular cost in its ability to provide credit. Now I think we're operating in the regime, or in the region of that continuum, where additions to capital, they may make the system safer, but they will come at a cost. That's the more normal regime where we thought we were operating before, and we simply had misjudged what a safe level of capital was. And so now, operating in that system, I think we'll see that effect operate in a more traditional way.
Yeah, we had a question at the back.
Thank you, Governor Quarles. Edward Mills, Raymond James. Had a question about CECL. There's a big push right now for there to be a cost-benefit analysis on the standard, something that you seem to have supported previously. A lot of concerns about making sure there is a harmonization between the accounting standard and regulatory capital rules to make sure that there is not a extra counting of capital and not a negative pro-cyclical impact of the rule. Could you give us an update as to how you view the need for a cost-benefit analysis and how the Fed and other regulators could harmonize this standard with existing capital rules?
So I think we've proposed this. If we haven't proposed this, we'll propose it shortly in real time. But from the regulatory point of view, we will phase in the use of CECL in our regulatory capital calculations. That will give, and we'll phase it in both with respect to the spot capital regime and with respect to the stress testing capital regime. And that will give us time to evaluate what the effect of CECL is going to be, because I agree with you. There's a lot more. We've gotten a lot of data. A lot of it is conflicting as to both what the day one effect of CECL is going to be and what is. There's less controversy, I think, less disagreement about what the effect of CECL will be in times of stress, that it will be procyclical, and therefore how do you address that? That's particularly important for our stress tests. It's also particularly important if there were ever any actual stress. So, but our view is that by phasing this in, by allowing a long time before it's fully effective, we will be able to do this further study to understand exactly what the implications are and therefore how we ought to respond.
Well, we're running over time. I'll take one more question here, and we need a mic. It's coming.
Hi, Brent Sutton from the University of British Columbia. Where do we stand on the incentive compensation rules? The second set were issued in 2016. I think they're in limbo at the moment. And secondly, is it possible that you could use the joint guidelines that have already been issued as a way of meeting the requirements under 956 of the Dodd-Frank Act?
The incentive compensation rules we've received a number of comments about the proposals that are out. There are a lot of technical issues with them. However, we are very much mindful of the incentive compensation principles that underlie that provision of Dodd-Frank and that underlie the regulatory proposals in our regular supervisory engagement with the firms. So that is something that we take into account. We look at firms' compensation practices when we do our regular examinations. It's not something that I think I said to Senator Menendez, this has not been fallen behind the refrigerator and been forgotten about. Our press people don't like me to use that phrase, and I just used it again. But
Stick with it. Go for it.
So I mean, we are focused on that in our engagement with the firms. Turning it into a rule, has raised a number of technical complexities. We're continuing to work on that, but it is not. While that rule is still being thought about, it's not something that we're not doing in our supervision and regulation of firms.
Thank you. Please join me in thanking Vice Chair Quarles for being here. That was just terrific. Thank you so much. Fantastic.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.